Most people think business is simple. You sell something, money comes in. And if a lot of money comes in, the business must be doing well. But that is one of the most dangerous misunderstandings in business, because revenue and profit are not the same thing. And many people learn that lesson too late. They look at sales and think they are winning. They see money coming in and think the business is healthy. They get excited because customers are buying. But then, at the end of the month, they look at the numbers and realize something painful. The business made money, but the owner did not. So in this video, I want to explain the difference between revenue and profit in simple language, why this difference matters so much, and how beginners can avoid one of the most common business mistakes. And before we continue, please subscribe, like this video, and leave a comment below. That really helps us grow the channel and helps more people find simple lessons on money, business, and smarter financial decisions. Let's start with the basic definition. Revenue is the total money your business brings in from sales. Profit is what is left after expenses. That is the simplest way to understand it. Revenue is what comes in. Profit is what stays. And this difference is everything. A business can have high revenue and still have low profit. A business can look busy and still be financially weak. A business can sell a lot and still struggle to survive. That is why revenue can be exciting, but profit is what really matters. Let's make this practical. Imagine someone sells products online. In 1 month, they sell $10,000 worth of products. That sounds great, $10,000 in revenue. But then they start subtracting the costs. They paid for the products. They paid for packaging. They paid for shipping. They paid for ads. They paid transaction fees. They paid software subscriptions. They paid maybe a designer, a freelancer, or someone helping with customer service. And after all of that, maybe only $1,000 is left. Or maybe nothing is left. Or worse, maybe the business actually lost money. That is why revenue alone does not tell the whole story. Revenue tells you how much money came through the business. Profit tells you whether the business actually made money. This is a lesson many beginners learn too late. They celebrate sales before understanding costs. They chase growth before understanding margins. They focus on looking successful before making sure the business is actually healthy. And that can create real problems. Because revenue can create an illusion. When money is coming in, it feels like progress. But if too much money is going out, the business may be weaker than it looks. That is why every beginner in business needs to understand expenses. Expenses are the costs required to run the business. Some expenses are obvious. Rent, salaries, equipment, raw materials, advertising, shipping, taxes, software, utilities, maintenance. But some expenses are less obvious. Time, mistakes, refunds, discounts, waste, bad pricing, slow payments, overcomplicated systems, and the owner not paying himself properly. All of these things affect profit. This is why smart business owners do not only ask, how much did we sell? They also ask, how much did we keep? That is a better question. Now let's talk about profit margin. Profit margin is the percentage of revenue that becomes profit. For example, if a business brings in $1,000 in revenue and keeps $200 in profit, the profit margin is 20%. That means for every dollar that comes in, 20 cents stays as profit. This is very important because two businesses can have the same revenue but completely different profit. Imagine business A has $10,000 in monthly revenue and keeps $3,000 in profit. Business B also has $10,000 in monthly revenue but keeps only $300 in profit. From the outside, both businesses may look the same size, but financially, they are very different. One is much healthier than the other. That is why profit margin matters. It shows how efficiently the business turns sales into real financial result. And this is where pricing becomes very important. Many beginners price too low. They think low prices will help them get customers. And sometimes low prices do attract customers. But low prices can also destroy profit. If your price is too low, you may sell a lot and still not make enough money. This is a huge mistake. A business is not healthy just because people buy. A business is healthy when it can serve customers, cover costs, pay people properly, and still have profit left. That means pricing has to be connected to reality. You need to know your costs. You need to know your time. You need to know your value. And you need to know what profit you actually need to stay alive and grow. Many businesses fail not because nobody wanted their product. They fail because the numbers never worked. The offer was attractive. The customers were interested. The revenue existed. But the profit was too small. That is painful, but very common. Now let's talk about cash flow. Revenue, profit, and cash flow are connected, but they are not exactly the same. Revenue is sales. Profit is what remains after expenses. Cash flow is the movement of money in and out of the business. A business can be profitable on paper and still have cash flow problems. For example, maybe you made a sale today, but the customer pays you in 30 days. Meanwhile, you still have to pay rent, suppliers, salaries, and bills now. That creates pressure. Now let's look at a simple real-life example. Imagine a small cafe. The cafe is busy every day. Customers come in, coffee is selling, food is selling. The place looks alive. From the outside, everyone thinks, this business must be doing great. But behind the scenes, the owner has many costs. Rent, electricity, water, staff, coffee beans, milk, food ingredients, cleaning, equipment repairs, taxes, payment fees, marketing, unexpected expenses. At the end of the month, the cafe may have strong revenue. But if the costs are too high, the profit may be very small. The owner may be working all the time but taking home almost nothing. That is not unusual, and it shows why business owners must not be fooled by activity. Being busy is not the same as being profitable. Selling a lot is not the same as keeping money. Looking successful is not the same as being financially strong. This lesson applies to almost every business. A freelancer can have many clients but still not profit enough if the prices are too low and the workload is too heavy. A shop can sell many products but lose profit through discounts, returns, and poor margins. An online business can have lots of traffic but lose money on ads. A service business can grow revenue but become less profitable because it hires too fast or operates inefficiently. That is why revenue vs profit is not just an accounting idea, it is a survival lesson. Now, how can beginners avoid this mistake? Let me give you 5 simple steps. Step 1. Know your real costs. Do not guess. Write down everything your business costs. The obvious costs and the hidden costs. Materials, labor, rent, tools, software, taxes, marketing, delivery, maintenance, your time. If you do not know your real costs, you cannot know your real profit. Step 2. Understand your margin. Ask yourself, for every sale, how much do I actually keep? Not how much comes in, how much stays. This is one of the most important questions in business. If you sell something for $100, but it costs you $90 to deliver it, then your real profit is very small. And if anything goes wrong, you may lose money. Step 3. Price with profit in mind. Do not price only to attract customers. Price in a way that allows the business to survive. Of course, customers must see value. But the business must also be sustainable. A price that wins customers but destroys the business is not a good price. Step 4. Track numbers regularly. Do not wait until the end of the year to discover that your business is not working. Look at the numbers often. Weekly, monthly, regularly. You do not need to become obsessed, but you do need to be aware. Business owners who avoid numbers usually pay for it later. Step 5. Do not confuse growth with success. This is a big one. Growth is not always good. More sales can also mean more pressure. More customers can mean more costs. More revenue can mean more complexity. The question is not only, are we growing? The better question is, are we growing profitably? That is the key. Because unhealthy growth can break a business. Healthy growth strengthens it. Now let's bring this together. Revenue is important. Without revenue, there is no business. But revenue alone is not enough. Profit is what allows a business to survive, pay people, invest, grow, and reward the owner for the risk and effort. That is why beginners must learn this lesson early. Do not be impressed only by sales. Do not celebrate only money coming in. Do not build a business that looks successful but leaves you exhausted and broke. Learn the numbers. Know your costs. Protect your margins. Watch your cash flow. And build a business that is not only busy, but healthy. Because the goal is not just to make sales. The goal is to build something that actually works. So here is the bottom line. Revenue is what comes in. Profit is what stays. And cash flow is what keeps the business alive. If you understand those 3 things, you are already ahead of many beginners. So here is your action step. Look at one product, one service, or one offer you sell or want to sell. Write down the price. Then write down every cost connected to delivering it. Then ask, how much do I really keep? That one question can change how you think about business. If this video helped you, subscribe to Business Made Simple, like the video, and leave a comment below telling me this. What do you think most beginners misunderstand about business numbers? That really helps us grow the channel, and I appreciate it. Thanks for watching.